loan interest rates are hovering around 5% and are at or near record lows. Credit card interest rates are not at record lows. They are as high as ever, often up and around the 17% per annum mark. GPs should not have significant credit card debts. That 17% is very expensive, and it's made worse by not being tax deductible. You're paying an effective pre-tax equivalent of 28% or even more, depending on your marginal tax rate. Paying off that hyper-expensive credit card is step one in getting ahead financially. Ideally, you'll pay cash, but sometimes it's not that easy. If you're strapped for cash, think about consolidating your 17% credit card debt onto your 5% home loan. Most GPs with a home loan will be able to do this, courtesy of recently rising home values, if nothing else. And think about then dedicating the 12% cash saved to faster home loan repayments. That could save you tens of thousands over the term of the loan. Or think about a business loan. For example, one recently fellowed non-owner GP strapped for cash and with a $20,000 17% credit card debt negotiated a $20,000 personal loan at 10%. He used the personal loan to pay $20,000 of management fees. This freed up $20,000 of patient fees to pay off the credit card. His effective pre-tax interest rate fell from 28% to 10%. Suddenly, he was back on his financial feet and in the market for a new home, where he promptly encountered a $1 million home loan to get something suitably sensible in Sydney. The flip side of rising average home prices is rising average home loans. GPs are taking on more and more debt to own that home. Once a $1 million home loan was very rare. Now it's very common, particularly in Sydney and parts of Melbourne. We don't blink. It's become the normal presentation. The good news is that over 20 years, Australian property has averaged about 9.8% per annum, which means in the very long term, these $1 million home loans will probably pay off. The bad news is, in the short term, interest rates could rise, and if they do, property values will fall. We may be seeing this already, with more on the way soon. What can you do to insulate yourself from the risk of rising interest rates? Simple. Pay off your home loan as fast as possible. Paying off your home loan is one of the best investments available to doctors. It's right up there with investing in a practice and large super contributions. If your marginal tax rate is 40%, it's the same as earning 8.3%. And if your marginal tax rate is 47%, it's the same as earning 9.4%. That's before tax and effectively risk-free. It's a persuasive case for paying the home loan off as fast as possible. That recently fellowed non-owner GP asked me if he should do extra locums on the weekend. The money is good and he's single with time on his hands. My response was immediate and firm. Yes, definitely. As many as you can, as often as you can. Work hard at building your base now, so you can work less later when you're married with kids. The opportunity cost of working long hours now is minimal compared to the opportunity cost of having to work long hours later with a long-suffering spouse and kids at home wondering where dad or mum is. Make hay while the sun shines and pay off your home loan as fast as possible.